Welcome back everyone to our YouTube channel. Today we have some practice quizzes from Section 13, Types of Mortgages and Sources of Financing. If you are a regular viewer of our channel, you know the drill. But if you are a new viewer, then welcome to our channel. So how this works is, I will ask a question and give you some time to think about the option and then choose your answer. Alright then, let's start the quiz without any further delay. Okay, question number 1. In a deed of trust transaction, which of the following occurs? And here are your options. Option A. The beneficiary conveys title to a trustee in exchange for loan funds. B. The trustee conveys title to a beneficiary in exchange for loan funds. C. The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. D. The trustee conveys title to a trustor in exchange for loan funds from the beneficiary. Alright, now go ahead and think about the option and make your selection once you're ready. Alright. I hope you had enough time to think about the options. If you want some more time, you can pause the video and think about your answer. Okay, let's see what the correct answer for this question is. Well, the correct answer is going to be Option C. The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. A deed of trust conveys title to the property in question from the borrower, trustor, to a trustee as security for the loan. The trustee is a third-party fiduciary to the trust. While the loan is in place, the trustee holds the title on behalf of the lender, who is the beneficiary of the trust. Alright, question number 2. The Federal Reserve's Regulation Z applies to which loans? A. All loans. B. All loans secured by real estate. C. All loans secured by a residence. D. All loans over $25,000. Okay, take your time to think about the option and then make your selection. I hope you have made your selection. So the correct answer for this question is C. All loans secured by a residence. Regulation Z applies to all loans secured by a residence. It does not apply to commercial loans or to agricultural loans over $25,000. Its provisions cover the disclosure of costs, the right to rescind the credit transaction, advertising credit offers, and penalties for non-compliance with the Act. Alright, question number 3. The debt ratio formula used to qualify borrowers is A. Total debt divided by debt payments. B. Gross income divided by assets. C. Gross income divided by debts. D. Debt payments divided by gross income. Alright, go ahead and make your selection. I hope you have your answers ready. Now let's see the correct answer for this question, and the correct answer is Option D. Debt payments divided by gross income. This was a pretty easy question. I hope you answered it correctly. But even if you didn't, don't worry, we still have more questions. Alright, here's the next question for you. Which of the following are methods used by the Federal Reserve System to regulate the money supply? Option A. Selling securities, printing money, and controlling lending underwriting requirements. B. Buying securities, changing the discount rate, and controlling banking reserves. C. Printing money, changing interest rates, and selling T-bills. D. Controlling the prime rate, trading securities, and purchasing loans. Alright, now I am going to give you some time to think about the options. Okay, let's find out the correct answer together now. So the correct answer for this question is Option B. Buying securities, changing the discount rate, and controlling banking reserves. The Federal Reserve System regulates the money supply by means of three methods: selling or repurchasing government securities, primarily Treasury bills, changing the reserve requirement for member banks, changing the interest rate, or discount rate. The system charges member institutions for borrowing funds from the Federal Reserve System. Okay, question number 5. A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains title to the property. This is an example of Option A: intermediation, B: forfeiture, C: hypothecation, D: subordination. Alright, take your time and make your selection. I hope you have made your selection. Let's see what the correct answer for this question is. Well, the correct answer is Option C: hypothecation. Let's now understand what hypothecation is. Well, it is the process of securing a loan by pledging a property without giving up ownership of the property. Question number 6. A borrower obtains a 30-year, fully amortizing mortgage loan of $50,000 at 8%. What is the principal balance at the end of the loan term? Option A: $2,000, B: $50,000, C: $220, D: 0. Alright, I hope you have your answers ready. So the correct answer for this question is D: 0. Well, the reason for this is that if a loan is fully amortizing, its loan balance is 0 at the end of the loan term. Question number 7. Lenders use an income ratio in qualifying to Option A: ensure a borrower has the earning power to make the loan payments, B: compare a borrower's earnings to the borrower's short-term debt, C: identify the highest possible interest rate that the borrower can afford, D: quantify the borrower's assets to the fullest extent. So the correct answer is Option A: ensure the buyer has the earning power to make the loan payments. Both the income and debt ratios and borrower qualification quantify how much a borrower can safely afford to pay on a mortgage loan. The income ratio focuses on the borrower's earning power. Question number 8. Under the Equal Credit Opportunity Act, a lender, or a real estate agent who assists a seller in qualifying a potential buyer, may not. Option A: tell a rejected loan applicant the reasons for the rejection. B: ask the buyer/borrower about his/her religion or national origin. C: ask the buyer/borrower to explain unconventional sources of income. D: use a credit report that has not been provided to the borrower. The correct answer is B: ask the buyer/borrower about his/her religion or national origin. COA prohibits discrimination in extending credit based on race, color, religion, national origin, sex, marital status, age, or dependency upon public assistance. A creditor may not make any statements to discourage an applicant on the basis of such discrimination or ask any questions of an applicant concerning these discriminatory items. A real estate licensee who assists a seller in qualifying a potential buyer may fall within the reach of this prohibition. Question number 9. The assumability of an FHA-insured loan is Option A: unrestricted, B: limited by when the loan was originated, C: limited to owner-occupied properties, D: prohibited on all existing loans under current regulations. Alright, go ahead and make your selection now. Okay, the correct answer for this question is option B, limited by when the loan was originated. Rules for assumability vary according to when the FHA-insured loan was originated, and whether the original loan was for an investment property or an owner-occupied principal residence. Loans originated before December 1, 1986, are generally assumable without restriction. Loans originated after December 1, 1986, require that the assumers show creditworthiness. Some mortgages executed from 1986 through 1989 contain language that is not enforced as a result of later congressional action. Mortgages from that period are now freely assumable, despite any restrictions stated in the mortgage. Alright, question number 10. The Equal Credit Opportunity Act prohibits a lender from option A, refusing a loan because the borrower does not match the lender's target market. B, including income from self-employment in the borrower's qualifying income. C, requiring both spouses to sign the loan application form. D, refusing the loan because a borrower has a defective credit report. Okay, the correct answer for this question is going to be option A, refusing the loan because the borrower does not match the lender's target market. The Equal Credit Opportunity Act, ECOA, requires a lender to evaluate a loan applicant on the basis of that applicant's own income and credit rating, unless the applicant requests the inclusion of another's income and credit rating in the application. In addition, ECOA has prohibited a number of practices in mortgage loan underwriting, including refusing a loan on a property based on an applicant's demographic characteristics. Alright guys, that was all for today's video. Check out our website dolphinschoolofrealestate.com to get access to various real estate courses and quizzes. Don't forget to check out our rest of the videos from different sections. If you found this video helpful, give it a thumbs up and don't forget to like, share and subscribe to our channel. And we will see you in the next one.